I want to now plead to turn the program over to Ms. Denise Rolock Barnes, the publisher of the Washington Informer. Denise.
Thank you, Austin, and thank you, Ms. Liggins. You know, we are ready to get started and to get into this conversation. And I want to thank everybody for being here this evening. We won't take too much time with introductions and what have you, but I am so honored that we have been able to do this project over the last year. I'm going to just tell a little quick story that when we decided that we wanted to look at home ownership in the District of Columbia and how to preserve Black homeowners, home ownership in the district, one of our premises was that people were losing property due to taxes. And very quickly we found it appears that may not necessarily be the case, that there are programs that the District of Columbia has put in place to ensure that people are able to save their properties, to you know, get their taxes paid, or to have, there's a process by which, but we do realize that there are lots of other reasons why people are losing their properties. And this is why we wanted to make sure that we did this Our House issue. And I'm honored to have Austin as our editor of the managing editor of the Our House newsletter. Speaking of being honored, I'm particularly honored to have, or we're honored to have with us Council Member Trayon White from Ward 8. He is a lifelong resident of Ward 8 and is very, very concerned. I've heard him recently on a couple of other webinars speaking about his concerns to maintain homes for his constituents, to maintain their homes in this community. And we all know, because it was talked about quite a lot, you know, that this was the last frontier when it came to Black home ownership in the district. So it's my honor to introduce Councilmember Trayon White, and thank you so very much for being with us this evening.
Thank you. Thank you, Ms. Bonds, and the family and those advocates on the Zoom today at Our House. As we talk about taxes, when you first started talking, it gave me chills, because I remember one time I got a tax assessment, and then within 2 years, taxes on one of my property went up 11%, and it was about $300. And I started to think how many residents didn't have an extra $300 to pay in taxes. Then I learned that I can attest it and go through that, which you'll learn more about today. Founding father Benjamin Franklin once wrote, but in this world, nothing is certain except death and taxes. And so as we think about this, we have a responsibility, I know I do as a government and working in the government, to figure out ways to keep people here. As we know, in Washington, D.C., we're facing gentrification all throughout the city, and it's pushing east of Anacostia River. And so we know that they are some of the most vulnerable residents here east of the river. And so it's imperative that we do innovative things. Like I have a bill called displacement free zones that's designed to freeze taxes in and around areas hardest hit by development. But that affects personal property taxes and also business taxes. And I believe that the key to wealth is ownership. And we have to increase our home ownership and business ownership right here in our community. And so I want to thank everyone who's joined today. I did want to note a few programs like the Homestead Deduction program, which I see we have a representative here today, which is available for property owners living in a principal residence with 5 or few units. The deduction reduces the assessed value by $75,700. Also, the senior citizen or disabled property owner tax relief provides about 50% reduction for property owners who reside in a property in question, or at least 65 years old, disabled, or do not have total federal adjusted gross income more than $134,555 a year. There are a number of programs we can take advantage of, but it's imperative that we get the information out. Just like with other Black neighborhoods, there are other areas facing gentrification of divestment, environmental injustice, followed by more recently decades of extreme gentrification has forced families out of their home. And we heard you, Mr. Denise Rolock Barnes, talk about what's happening with our seniors, which is also a predatory population that we hear and get calls, that people are getting calls about trying to take their homes. And so we have been committed to ensuring we can put protections in place to keep our residents here and keep the property taxes down, even though they're going up. So I want to thank you all for having me. I look forward to the informative dialogue today. Thank you all for having me on our house.
Thank you so much, Councilmember White. And one of the things I also want to add is that this is not the first go round for the Office of Tax and Revenue. These webinars are held annually. And we'll make sure that everyone gets a chance to see this recording, but we want folks to keep their eyes and ears open for future conversations that the office also sponsors. We're going to take one poll question right now. We have about a nice audience so far of about 60 plus people. And we want to know from which ward or in which ward do you live? So we're going to put that, is that up, Chevy? Okay, so we'll take a few minutes to answer that question. And I will say that we asked several people in the community already, what questions would you have for our guests this evening? So we have a quick video we want to share with you as well.
What's the difference between the 2022 current assessed value compared to the 2023 proposed assessed value? And does the current assessed value have anything to do with the current value of my home? Is the proposed property tax, the property assessment, is that based on the land, or is that based on the land and my home, or some other kind of calculation? So if someone could just explain to me how they come to this assessed value, that'd be great.
How are the taxes assessed? Particularly, how are they projected? On each of the tax bills, it has the current year as well as the future anticipated taxes.
Why do they send the tax bill as a real bill if it's always paid by my mortgage? Why can't they just send a reminder that says for information purposes only? Thank you.
What does all of that mean? What's the information that's on the document? I've been getting it for a long time now. I've been a long time homeowner, but never really understood what all of that information meant.
What major projects are going to be done as a result of our tax revenues this year, and when will we be receiving the information about those specific projects?
And we had a $30,000, I believe, surcharge or assessment, if you will, increase. So we did do some development on the house. So I don't know if it was related to that or if it's related to what's going on in the market. My second question is, in general, overall, what do these taxes actually support? Is this, administrative opportunities, for management of the city, or is it city services? Is it, what do the OTR assessments, really, how is that money being applied, if you will? And as people are late, what types of programs do they have if you don't have it in escrow in your mortgage?
So thank you very much. Now it's my pleasure to introduce our two speakers this evening. We have Mr. Yomi Omotoso, who is the Chief Appraiser for the DC Office of Tax and Revenue, and Mr. Stephen Skolron, who is the Manager of Homestead Unit. So we'll start with Mr. Skolron, and then from there we'll go to Mr. Omotoso. Thank you very much and welcome to our program.
I think I'm the one who's going to kickstart it. My name is Yomi Omotoso, as you have mentioned, and then Mr. Skolron is going to come after me. I want to say thank you, Ms. Denise Burns and Mr. Cooper, for organizing this. And I want to thank my colleagues from the Office of Tax and Revenue that are joining us as well. And at the same time, I say good evening to everybody that is on this channel. Please, you have to pardon my voice. I'm just getting over cold. So my voice may not be clearer, but I hope everybody can hear me a little bit clearly. So I'm just going to speak about assessment in general and how values, for those assessed value that you receive in your assessment notice get generated. And hopefully, if people have questions after, I go through the slides, then I can answer them as much as I'm able to do tonight. So what is an assessment? Because that's the first question. Everybody here, assessment. Assessment is basically the estimated market value of a real property. And we use the word real property because property could mean anything. It could be a property is your car, but we're talking about houses here. So an assessment is just what is the worth of that property as of a given date. In the District of Columbia, as a jurisdiction, based on the code, an assessment of a property is the market value of that property. So in the district, 100% of what you can get for your property is the assessment. Now, if you go to the next slide, there are key definitions in what I just mentioned as an assessment. We talk about value, we talk about assessed value, and what are the ways in which we get what those market values are. The first thing is that the fair market value is based on what a property in an open market will command or will get. That is, if you put your property on the market, that is, you expose it to the market, just you are not under duress in selling. Maybe you hire an agent to list it for you. You receive multiple offers, you go through them and you select one. In that wise, we're talking about that is a fair market value. That is, it is what a willing buyer and a willing seller will bargain for, and they can come to a compromise price. That's a fair market value. And in the district, the estimate of that fair market value is what the assessment is. The key date in the district is January 1 of every year. So the valuation date for every assessment or the assessment notice that you receive, the valuation date is January 1. What that means is that if you are selling the property on January 1 of any year, how much can you get for it? Or how much can you probably get for it? It doesn't matter whether you are trying to sell or not, but that date is very, very important. And the approaches to getting the estimate of market value, and this is valuation itself, we use what we call mass appraiser. In the district, I can tell you that this year alone, we released assessment notices for 207,109 properties. You will ask me that, are we able to go to each 200,000 properties one by one? The answer is no. But there's a method or a methodology in which you can value all those properties. That is what they call mass appraisal. And that process basically is looking at multiple properties at a time to come up with the estimate of value for each one of those properties. And there are three methods that are key in arriving at the estimate of value for each property. One is what we call the cost approach. The cost approach is simply, if I'm building the house today, how much will it cost me to build it, plus the land? And because if the house is not newly built, there's always a depreciation that is factored into it. So it's the land value, the cost to build, plus depreciation or minus depreciation, and then you get the estimate value. That's cost approach. The other one is called the sales comparison approach. This is basically comparing apples to apples. If I have a 4-bedroom house with 2 bathrooms, we're going to look for other 4-bedroom houses with 2 bathrooms. How much did they sell for in recent time? We make adjustments and then we come up with the value. So it's comparing apples to apples to determine what the fair market value of the subject property will be. The last one is what we call the income capitalization approach. This is typically used for commercial properties or a property that their value is, the latent value of them or inherent value in them is because of the income that they can generate. An income approach is basically when you take the rent, you take out the expenses, you get what you call the net operating income, and you capitalize it by what you call the cap rate, and then you come to the value. But that particular approach is usually used for commercial properties. If we go to the next slide. So in the district, this is the code. And this is the basis for assessment because we have to follow the law. The law says that market value is 100% of the most probable price at which a particular piece of property, if exposed to the open market, in a reasonable time for seller to find purchaser will be expected to transfer under prevailing market conditions. And that's between the two parties who know exactly or have the knowledge of what they can use the property for. And both of them are seeking to maximize their gain. And none of them is in a position to take advantage of the other. So the key thing here is that, number one, the property is exposed to the market. The seller and the buyer are acting in what they determine to be in their best interest. None of them is trying to take advantage of the other. And if those parameters are in place, you can say the value that you have arrived at is the estimated market value as of January 1. So what are the things that can affect value, or what are the things that can go into this value? If we go to the next slide, and these are the areas in which I want people to begin to pay attention to. One is change in market factors that can increase or decrease value. I've had several, conversations with people. When you see things, that improves the neighborhood, let's say maybe a new shopping mall comes to the neighborhood, there's employment in the neighborhood, a new transportation route, new routes, and all those things. Those are factors that although they are external to your properties, but they can actually increase the value of your property. And if things begin to deteriorate as well, no roads, no good schools, and what have you, those things can actually affect property value. The other thing are structural changes in the property. I think like the gentleman that we just listened to his question mentioned, he did some improvement in his house. So if you do, for instance, an addition to your house, say you increase the square footage, you had a bedroom, you had a bathroom, all those things can actually increase the value of the property. And otherwise too, if there's a demolition, if there's a damage, God forbid, fire damage or water damage, that can decrease property value. Sometimes people may have a larger lot and you split it into two or you combine it. That can increase or affect the property value. Sometimes when there's a zoning change, maybe the zoning now allows you to have a higher density, or sometimes the zoning, will put some restriction on what you can do. It can affect the value of the property. And then sometimes government imposed restriction. A very good example of this is cases where you have rent control. Even though you may be able to achieve more rent in your property, but because the government says you can't charge more than X amount of dollars, that can affect the property value as well. So if we go to the next slide, and this becomes key, and I mentioned it earlier on, a lot of people or most homeowners are used to what we call the single property appraiser. And for us, as in the Office of Tax and Revenue, or at least in any assessment jurisdiction, what we do is mass appraisal. That is, we look at multiple properties at the same time. I use some formulas and methods, some I mentioned earlier on, to determine what their values are. For instance, single property valuation is just valuation of one property on a given date. Mass appraiser is appraisal of many properties of a given date. But in mass appraiser, we use the same three methods, but we use what we call statistical testing. What those statistical testing does is it makes sure that we are comparing apples to apples, even though we're looking at a larger pool of properties at the same time. And we're making sure that we're eliminating what we call the outliers and what have you. So in other words, when we finish the assessment, even though we're doing it on a mass basis, the values should not be far or too different than if we're doing it as a single property appraiser. So the three approaches still apply here. Then we use statistical method to test it. The only difference between the single property appraiser and the mass appraiser is because of the scale and the quality control that you apply. So that in a nutshell speaks about how we appraise property, what assessment means, and what, how assessed value are derived. The next slide that I'm going to show you is just a snapshot of the most recent assessment exercise that was just concluded as of January 1 of this year. This is a table that summarizes all the assessment of all the taxable parcels in the district. The residential, you see, is the largest. Our assessment from last year and the proposed assessment for 2023 are in columns, the third and the fourth column. And you can see the whole dollar change and the base change percentage. Now, for residential, we can see that there's an increase overall in the district of about 6.58%. And if you go down that way, the only sector that we're still seeing a decrease is in the retail sector. And we all can allude this to, what is the current prevailing circumstances brought by the COVID pandemic. But we're hoping that, as COVID, begins to get out of our ways and we begin to enjoy our life back, people will begin to visit, some of these restaurants, and little, retails and front stores again. And that activities can begin to elevate, the values of these properties as well. If we go to the next slide, which I think is a little bit more interesting, this is just residential properties for each ward, how they compare to last year. Last year is TY 2022, 2023 is what we're proposing and the difference. And you can see the base change or the overall change. Now, I often try to caution here that sometimes when we look at the averages and you see the numbers, people can say, oh, is my property going up by 10%? The answer is generally no. Because when you see your own assessment, you may not see actually a 10% increase for everybody. This is just an accumulation of all the properties and taking an average of that difference to say, okay, the whole world, everybody is going off on average, or the property is averaging 5% or 10%. The actual percentage increase or decrease for each property is probably not going to be 7% or 5% as represented on this chart. Now, there are avenues to look at this number and say, what can I do? Actually, if you go to the next slide, this is just a map. I hope everybody can see it on that represent the table that I just presented. But actually, the slides that I need is the next one, which is, I want to emphasize a little bit on this notice. Sometimes when people receive this, they may think this is their tax bill. This notice is not a tax bill. It is basically what it says, the notice of proposed real property assessment for tax year 2023. And I think one of the questions the lady in the video first asked is, what is the difference between 2022 and 2023? In the area where it says 2022 current, is showing the current assessment of the property. The 2023 proposed is now showing what we have estimated the value to be as of January 1 of this year. And taxes are not going to be due on that until March next year. But there are avenues, if you conclude that that value is not reflective of what you think your property is worth as of January 1, there are avenues to protest that. And that's in the next slide. So the next slide says how to appeal this notice. You can see that it is still a notice. It is not a tax bill. It is just informing the property owner that this is what the Office of Tax and Revenue have estimated your property to be valued at as of January 1. And if that does not reflect it in your own estimate, you can appeal it. But the date to be very aware of is April 1. Appeals must be received by April 1 for us to treat it. Right now, we can accept appeal electronically. Actually, we encourage everybody to file it electronically. It's easy. If you go to mytax.dc.gov, all you have to type in is your SSL or the address of your property, and then you can file your appeal within a click of a button. Now, there are 3 levels of appeal in the district. The first one is the administrative appeal, which is what we call the first level. At the first level, we will render a decision after we've dialogue with you, look at some other evidence and look at, maybe special circumstances about that property. And once we render a decision, you have 45 days. If you are still not satisfied, to appeal to the Real Property Tax Appeal Commission. They are an independent body who can take a second look at the assessment and render a decision. Now, if Real Property Tax Appeals Commission render a decision and the property owner is still not satisfied, they have the third recourse, which is what we call the third level, and that's going to the DC Superior Court. I can tell you generally that most residential appeal usually end in the first level. A few or a number will go to the second level, and many of those, I can say at least about 98 or 99% get resolved at that level. So majority of residential owners don't usually go to the third level. So there are avenues to really protest what those numbers are. Now, if we go to the next slide, sometimes a lot of people, and this is just, for the public consumption, many times we see the value and we don't like the value, but the basis for protesting your assessment is not usually or depending on value alone. There are some other things that you can see in your property that you can still appeal the assessment on. The first one is value, which is whether, you believe the assessment is accurate or it's not reflective of your property value. The other one is what is called the tax classification. In the district, there are 4 tax classes. Class 1 is usually residential. Class 2 is commercial. Class 3 is the blight, and the class 4 is the abandoned and blight. But I'm going to focus on class 1 and 2 because the Office of Tax and Revenue does not even control class 3 and class 4. But class 1 and class 2, which is residential or commercial, is all commercial properties are supposed to be taxed at class 1. Peradventure, there's a change in class that you notice. Sometimes this can happen when there's a conversion, maybe from a commercial use to a residential use, and we may not know it, and the record still says class 2. So in other words, you will still get taxed at class 2. But if you notice that there's a discrepancy about your tax classification, you can protest that. The other one is the property condition. The subject physical condition is not consistent with what we have. Say, for instance, the basement gets flooded and is damaged. There's no way we're going to know that, but the property owner will know that. So our record is still going to reflect that your basement is okay. And I'm using that as an example. There could be any other damage to the property. But if you bring that to our attention, we will correct it. And that can actually reduce the assessment. The other one is what I call errors on property record. Sometimes property change. Say, for instance, I mentioned if you have a 4-bedroom house the other time, somebody may feel like maybe my 4 bedrooms are too small. I need a bigger master bedroom. And then you combine 2 bedrooms into 1. Invariably, your house has now become 3 bedrooms. So that is a change on the record. We may not know that. So if you find an error, let's say, or you see that the square footage of your house is not what we think it is or what we say it is, you can protest the assessment that way as well. The other one is equalization, which I say is comparing apples to apples. If you notice that maybe your property is not being compared with the other properties that are similar to it in the same neighborhood or in the same market, that can be a basis to challenge the assessment. So I want us to pay attention to at least these 5 categories, not only the value, although value is very important, but there could be other ways in which you can protest the assessment. Now, I think I'm getting to the final slide now. this is how you can appeal the property. I just want to reemphasize that, or at least the property assessment. Every resident must submit their first level appeal application by April 1, because we have a filing system. It's automated. It's the system will shut down at 11:59 p.m. on April 1. So I encourage anybody that have received their assessment notices, and even if you are not sure, excuse me, if you're not sure or you don't really have the evidence, but you just think your property value is high, you have the opportunity to preserve your appeal rights. We will send you a notice, tell you a date for the hearing, and you have the option to submit documents that supports your value, or decrease or increase, or whatever the case may be. At least 48 hours before the hearing, we will look at all that and we will try to render a decision. And I'm hoping that if we render that decision, that will be satisfactory enough, and everybody will be happy about that. So that concludes my presentation. I'm hoping to answering any question at this time. And actually, if you go back to the other slide, if you don't mind, if you still need either further clarification or you'd like to contact us, I believe Ms. Denise is probably going to share this slide with everybody. There's an email there, and there's in the mytaxdc.gov. You can drop us, any message on the portal, and we'll be able to answer you. Thank you for giving me the time to share this with you this evening. I will take any question if anybody has one.
Thank you, Yomi. Yeah, we have quite a few questions, actually. I want to thank folks that put those questions both in the Q&A and in the chat. I didn't give instructions, so I apologize for that. But they're in both places. So a couple you've answered. One is, one I'll say is, if you qualify for more than one type of property tax deduction, can you get multiple deductions or only one at a time?
Okay, I think Steve is more qualified to answer that question than myself, because I think that's probably part of his presentation. So when we get to that, I think he'll be able to answer that.
Okay. Well, maybe what we should do is turn it on over to Stephen, and then we'll go back to the questions. I'll just ask the audience to continue to put your questions either in the chat or the Q&A. Either way is fine. And we're going to try to get to as many of them as we can. Stephen?
Thank you. Thanks for the opportunity to speak to you in representing the Office of Tax and Revenue, Real Property Tax Administration. My name is Steve Scowron. I represent the Homestead Unit of the Assessment Services Division. You can go to the first slide. Part of what I manage for the Assessment Services Division is the homestead applications, senior disabled applications, tax deferrals. My unit is also responsible for audits. It's not a happy topic, but it's one to ensure that if people are receiving benefits in the district, they are compliant with DC tax law. I'll talk briefly about the assessment cap credit, as well as do a brief overview regarding your property tax bills, how to make payments, and the various payment methods that are available to you. I'll also get into what are the requirements for the programs I just mentioned, how are these programs periodically reviewed, and what can I do if I disagree with the decision? And that relates to if your property is audited and we determine that you're not eligible for the benefits, there is an appeal process. We follow the same appeal process by DC code that Yomi talked about. So there is a first level appeal, which is more of an administrative appeal. And then if you disagree with our determination, you have the ability to go to a second level, which is before the Real Property Tax Commission. And then ultimately you have the ability to go to DC Superior Court. So you can go next slide, please. So the homestead benefit is for property owners that live in their properties and establish the District of Columbia as their permanent residence. And the way that we make that determination or that measurement is by the homeowner establishing domicile in the district. And that's a fancy way of saying, is this person a permanent resident or not? And generally what we look to, and we provide people an opportunity to, when they just first move into the district, the expectation is that once you are receiving the benefits that, and again, some of these are optional, but for most of us, we will engage in filing taxes on a regular basis. There are exceptions to that, but you're going to be filing your income taxes using your property address. If you drive, your driver's license, motor vehicle registration is going to be to your property address. If you choose to vote, your voter registration is to the property address. So those are the things that we look at in order to, or activities that we expect for you to establish domicile in the district. It can sometimes be nuanced in the audit process, but for new homeowners that are moving into the district, the expectation is that if you're new to the district, you're going to sever ties with whatever previous jurisdiction that you're coming from to the district. And then the caveat, if you're moving from one property to and purchasing another property in the district, you need to cancel one benefit and then reapply for the benefit to the new property that you're at. Next slide, please. The other thing that we have picked up on our audit process is that many district residents have multiple properties, both within the district and outside of the district. And especially for those residents that are moving from another state to the District of Columbia, the thing to be aware of is that you cannot be enjoying other real property tax benefits on the property that isn't your primary residence. So some states call their primary residential credit homestead. Other jurisdictions will call it different things. So it's not always the terms may be different, but it means the same thing. So the homestead deduction in the district means that house you're residing in is your permanent residence, your permanent home. The homestead deduction every year is assessed, and that deduction has historically increased every year. So for tax year 2022, the homestead deduction is $78,700. And that equates to an annual savings on your property tax bill of $668.95. And then that amount is split up between your first half and your second half tax bill. Common question that we get in the homestead unit is regarding the cap credit. So you may find that sometimes some years, more specifically, you'll find that you'll get a sentence on your tax bill that says your cap credit saved you X amount of money, as well as stating that your homestead benefit, at least for TY 2022, saved you $668.95 annually. The cap credit will only show up in your tax bill if your taxable assessed valuation increases more than 10% from the previous year. So if it's not there, that means that the value of your property, your taxable assessed value of your property did not increase more than 10%. So it's not going to show up on your tax bill. So some years, if your property valuation does increase above the 10%, for example, 12%, the homestead benefit in the background will ensure that what you pay is a taxable assessed value of a 10% increase. And then the bill will reflect what that 2% savings is for you in that particular year. So it's always on your property. It only goes into effect, and when it goes into effect, your tax bill will reflect that. Next slide, please. And so this is an example of what your property tax bill would look like. If you have a homestead benefit, it will say on there your homestead deduction is saving you the $668.95 annually. The homestead application is filed through mytax.dc.gov. Through that web portal, and again, I want to emphasize this multiple times, you do not need to log in. You don't have to create a login. You just go to the real property tax screen on the MyTax landing page, and then you'll click on real property, click on view more options, and then you'll see submit a homestead deduction. You'll put in your square and lot, and then you'll proceed through a series of questions that you have to answer. And then you hit submit, and the application is submitted electronically. And the average turnaround time is approximately 30 days, depending on what time of year it is and how many applications we get in. We try to keep it within 30 days, but in most times of the year, we're able to stay below the 30-day threshold. Next slide, please. Senior eligibility is a secondary benefit. So you're required to have homestead. You have to qualify for homestead in order to qualify, even be considered for the senior or disabled benefit. So if you're enjoying the homestead benefit, you are also eligible for the senior tax benefit. And the qualifications for that is based on age, household adjusted gross income. And we also look at whether or not the person who's applying for the benefit, who is eligible for it, actually has a percentage of ownership in the property. So seniors, to apply and to be eligible, you need to be 65 years or older. Your household adjusted gross income, we look at tax year, your federal tax filing of tax year 2020 for our current tax year, and your household adjusted gross income needs to be under $139,900. And this also includes all persons residing in the household. And this is excluding any tenants that you may have paying fair market value under a written lease. So keep in mind, I just had a elderly lady I was talking to on the phone. Her one daughter lives with her. She has a very good job. And with her residing at the house, it is causing the AGI to be above the $139,900 threshold, and she's not able to qualify. The other thing to keep in mind is that if you qualify and you are receiving the senior benefit, if for some reason in a particular tax year, circumstances change, you sold the property, sold some stock, and that household, that adjusted gross income increases, you're obligated to reach out to OTR to cancel the senior for that year. And then you can reapply when your adjusted gross income meets the eligibility threshold. So it's a fluid program. You can come in and out of the program. And there are some efforts that we are involved in to identify properties proactively, so we don't have to issue an adverse tax bill and then try to recapture savings. That's never a good situation to be in. So there are activities that we're engaging in to, proactively identify these properties and send out notifications and such. Next slide, please. With the disability tax benefit, the only difference, so the household AGI is the same, the 50% ownership is the same. The only difference here is that the disability benefit is not age contingent. It is based off of being certified by the Social Security Administration that you are permanently or totally disabled, or if you're receiving a district or federal government disability payments. And so that is another option that's available to individuals that meet these qualifications. And they will also enjoy forgive me for not saying this for the other slide. So the benefit you receive for a senior and disabled is a 50% reduction in your property taxes. It is pretty significant. So not only do you get the $668 savings for Homestead, you then get a 50% reduction in your property taxes. And not unlike the Homestead benefit, the senior and disabled cap credit is actually increased so that your taxable assessed value cannot increase more than 5% per year. So it also is a significant tax savings. If your property taxes go up 7%, the senior and disabled credit will prevent the property from being assessed more than 5% per year. And then, like I mentioned earlier, what your savings are, as well as what benefits you're receiving, all of those will be listed on your tax bill every year, as well as every half. Next slide, please. The other program that OTR offers is a tax deferral program for low-income and senior property owners. It is an option that the district offers. There are not a lot of participants in the program. I think there's approximately 200 individuals that take advantage of the program. Again, you can apply for this program if you meet the eligibility requirements through mytax.dc.gov. This allows qualified low-income senior property owners to defer the real property taxes owed currently, prospectively, and retroactively. And remember, the key word I want you to remember in this is that it's a deferral. You're basically postponing paying the taxes on the property until, in some instances, people use this as a way to maintain living in the property, and then they manage the taxes that are owed through their estate, or if life circumstances change and they end up selling the property, then the deferral amount needs to be paid whenever the property no longer qualifies to be in the program. And that information is on the slide. And I'm happy to answer any questions to that. But I'm also sensitive to our timeline. So next slide, please. So I talked about audits, and I also talked about the way that the district also proactively manages some of the programs. So every year between January and February, we take a look at the DC tax returns that are filed, and we look at the household adjusted gross income, and we look at what the threshold is. And for those residents whose income exceeds the threshold, we will send out notification and end date the senior benefit, stating that the property no longer qualifies because the household adjusted gross income exceeds the threshold amount. And And again, like I had mentioned, if you are in the Homestead Senior Disabled Program, if circumstances change and you no longer qualify for the benefit, more specifically, the property doesn't qualify for the benefit, we want to make sure that taxpayers notify us, and the way that that is done is through filing a cancellation of benefits, which is through an ASD 105 form. I want to just touch on one other thing while I'm thinking of it. For those individuals that may have some limitations and are unable to navigate website, have computer access, we do offer the ability for a taxpayer to call the Customer Service Administration. All you need to do is just ask for the form to be mailed, and we would be happy to mail it to your address, and you can complete it and then mail it in, and then that form will get scanned and uploaded into your account, and then we'll process that form. So, you know, as much as we want to embrace technology, we also have other avenues, because we also don't want to disenfranchise individuals that may not have computer access. So that is an option that is always there, whether it's for homestead or senior or disabled. That is an option if that's the route you need to go, if there's limitations of not being able to complete that form online. Next slide, please. I just included in this slide, if you do receive a senior rescission notice, it's letting you know that in this case, we sent out notifications that you no longer qualify for tax year 2022, and it provides instructions as to if for some reason you feel that our determination is incorrect. There's directions on how to appeal, as well as letting you know that even though you don't qualify in this particular year, we encourage you to reapply if your household adjusted gross income meets the qualifying amount for, let's say, for example, tax year 2023. Just as an FYI, for tax year 2022, we issued 138 senior rescission notices as a result of this data matching program that we have. Next slide, please. And then the other program that I like, because we want to provide taxpayers in the district as much information as possible. We also look at household owners, and we take a look at federal adjusted gross income, and we do some data matching, and we send out a courtesy notice. Not everyone that receives the courtesy notice is going to be qualified, because there are particular circumstances or information that isn't available that may have flagged them to receive this notice. So it is an opportunity to just remind residents in the district, if we can do some data matching and we think the property is eligible, we will send out a notice. And I am pleased to announce that this year we sent out more than 2,000 courtesy notices to district residents to make them aware of the senior benefit program. And we have had a really positive response with a large spike in senior applications that came into our unit. So I'm pleased that this type of notification is working, and we're letting people know that benefits there, what the eligibility requirements are, and if you meet them, by all means, apply. Next slide, please. Getting back to so I'm staggering some of the bad news with the good news. So, you know, part of the auditing is, I talked about senior rescissions. We also do, like I mentioned, courtesy notices. We also have to manage and look at auditing properties within the district. We have over 100,000 properties that are receiving homestead benefits. And of that 100,000 plus, that number is growing. 39,000, I think either 38 or 39,000 properties are receiving the senior benefit. So part of what we do is we want to make sure that properties that are receiving these benefits are eligible to receive them. So we have contracted with an external vendor to do some data matches for our audits. They are referred to as Tax Management Associates, also called TMA. We also receive tax tips. Residents of the district are our best allies. I receive numerous emails or receive phone calls where a neighbor is saying this person no longer resides in their house and the house is being rented out. Every tax tip that comes into my unit is taken seriously, and there is follow-up on all of them that come in. So, and if we deem that the property is not eligible for the benefit, we will remove it. So when we do conduct an audit, we conduct an audit for current plus 3 years. So we evaluate for the current tax year plus 3 years back to determine whether or not that property was eligible to receive those benefits. Another aspect of our auditing process is through a sale of property. So anytime a title company submits a tax cert, it's an opportunity for us to take a look at whether the seller is eligible to receive the benefits. If we deem that not to be the case, we will remove those benefits and assess the property accordingly to ensure that individuals that are receiving these benefits prior to selling their home, that those benefits were legitimately being received. Senior rescissions, like I mentioned, we do annually. And then we also have sample populations that we look at and determine whether they meet all of the eligibility requirements. Next slide, please. I briefly talked about the appeal process. Yomi talked about that as well. You have your administrative process. If you don't agree with our decision, you have the ability to go before a second level. Since I've been in the unit for more than 3 years, there was one case that went to DC Superior Court. So a lot of these are taken care of at a first level, as well as through the second level appeal process. Next slide, please.
Steve, I know we have some more slides, but I think this is a great opportunity to answer some questions because we really are at time.
No worries.
Thank you so much, Natalie, and thank you, Steve. This has been exceptional, and so much. I think the more information we get, the more questions we have. And so I do want to make sure that we get some of those questions answered. And I don't even know where to start. There's so many. I know one question that we had from, I think it was Keisha, Miss Mullins Anderson. Her question was, if her property taxes were overpaid, why am I not allowed to request a refund for the credit? And she says she also has to prove that her tax bill was paid. So she's really inquiring as to why she can't get a refund if her taxes were overpaid. Can either you or Yomi answer that question? Can you hear me?
Yes, thank you.
Okay.
Generally, depending on the particular circumstances, if you are the payer of the taxes and there is a credit on your account, Generally, you can submit a request for a refund, but you also have to show proof of payment. In a lot of cases, for example, if you have an escrow company paying your taxes and there's a credit on your account, then the escrow company has to apply for the refund. So whoever the payer is the entity that has to apply for the refund. If I don't know what the particular circumstances are, I'm more than happy to look at that. You're more than welcome to email me, and we can look at the particulars of of the situation that you're presenting.
Yeah, and let me also add that a refund can be requested after second half. Second half bill has to be paid. That's the end of the tax year, and so that has to be paid. And you can apply for a refund, but we have a 3-year statute of limitations. So if the credit is over 3 years, you wouldn't be eligible for a refund.
Aaron Martin asked that he said his taxes, are rolled into his mortgage via his escrow. He closed on a property, his house on December the 27th of 2021. And he moved into the property on January the 28th of 2022 and paid his first mortgage last month. However, within the last 2 weeks, he received both a tax assessment and a property tax bill due by March the 31st. Is this an error, or how should he address this, or she address this?
Okay, I think Steve can go on the tax bill, but like I mentioned, the valuation date for assessment is January 1 of every year. So we will establish value for the next tax year. So for the gentleman who says, I received my assessment notice because I just moved in January, the assessment notice, like I mentioned, is just advising you of what the property is valued at as of January 1 of this year. But the taxes for that assessment notice is not going to be due until March next year. That is why there's a avenue to protest that assessment between now and when the taxes are due. So that's about the assessment. I know Steve is probably going to shed a little light on the tax bill. And that's why I emphasized when I was going through this slide that you should pay attention to what the communication you are receiving, because one is saying assessment notice and it's different from the tax bill. So the notice is just to inform us of what, the value of the property is as of January 1, which taxes is going to be due next year, March. Steve, do you want to shed light on the tax bill?
These are a pretty specific set of circumstances. I would want to look at what had transpired on the property so I could, provide a accurate answer versus trying to guess what's going on. Like I said, I'm happy to follow up.
Yeah, I think that's safe when people have specific situations, and I think Yomi, your answer was a good one, but I think he would do well to contact you all specifically about that situation. There was a lot of concern when Yomi, you showed the tax increases in by ward, and there are a couple of questions. One was with the poorest, why does the poorest ward have the biggest increase, number one? And then the other that was related to that was, what impact does crime have on property taxes?
All right, let me take the second question first, because that's an easy answer. For assessment purposes, we don't track crime rate. As I mentioned during my presentation, there are certain things that can make or mar the value of a particular neighborhood or a property. So if there's crime in a particular area, people may not really want to move in there because they know what goes on there. So in other words, value may start going down because of something that is external to the property. And that's not we don't track that. Now, what we track is what property are bought and sold for. And I know that I mentioned during my presentation that sometimes when you're looking at those numbers, the averages, the median, they are good indicators, but sometimes they can be misleading. This is what I mean by that. Is somebody can say, oh, all the values of the property in Ward 8 is going up by 10%. That is not accurate. You're just looking at the aggregate of the number. And sometimes, because, for people who know statistics will know this, a small number can be magnified by percentage. What I mean by that is, if a house is, say, $100,000, and somebody bought it for $100,000, and you sell it for $110,000, that's 10% increase. But if I say, oh, all I have make over $100,000 house is 10,000, people may not look at it as a big increase. But when I say it's 10%, it becomes magnified. Now, in Ward 8, I can say this specifically because I ask myself the same question. Usually when we finish the assessment, we look at this number and say, what's going on here? I can tell you this, that in 2016, the median sale price in Ward 8, actually, let me just use neighborhood 2, which is Anacostia. The median sale price of homes in 2016 is $295,000. And we have 104 sales. So the median number is $295,000. Now, in 2021, we have 92 sales in the same neighborhood, and the median home price is $480,000. This is raw number. This is not, we didn't make it up. It's not assessment. We're just talking about how much people bought and sold these houses for. So in the last 5 years, you can say that the average increase or the median increase is 62%. If you divide that by 5, you are getting about 12% increase in sales price. These are not assessment. This is just somebody bought and somebody sold. So, and if you go back to what we say, that in the district, the assessment is actually 100% of the market value. And that's what assessment usually reflects. And I tell you that, you see that what we have is about 10% increase. So if you trend that, you will see that the assessment has actually lagged behind the actual sales, because even not all these sales is what we even still use in our assessment, because some of the sales could be a transaction that is what we call unqualified. Maybe they are not arm's length, maybe they are foreclosures and things like that. But the evidence just shows that although 295, 480 seems a small figure, but the trend is showing a strong market. So that's what is happening.
And that's the fear. I'll just add that. I mean, we can talk about that, and that's another conversation, but because now we understand how the taxes operate. But, with the increase in housing values, it seems as though, people are concerned about being priced out of neighborhoods that they've consistently been able to call home. We have a couple of questions about solar power equipment, the installation of solar power equipment. Does that increase your taxes or your tax assessment if you install solar panels?
Well, like I mentioned, if you install solar panels or you don't install solar panel, it is how much somebody is willing to pay for it. I can say this about solar panel because there are different ways you can have solar panels. Some of the solar panels are leased, so they are not, the homeowner's own. Some belongs to the homeowner. Now, if somebody is willing to buy the house with the solar panel or take over the lease of the solar panel and they are willing to pay X amount above or below what the market value of the home is, then that becomes the price of the house. So, but we don't track how many homes have solar panel versus, how many homes don't have it. But if it bears out in the price that somebody is willing to pay or price that somebody is not willing to pay, then that becomes an evidence of that transaction. And that can ultimately lead to what the assessment of the property is. And I want to really emphasize this, if you don't mind, maybe in just a few seconds. I don't want people to think of assessment as being the tax. I think Steve, kind of clarified that. See, the assessment is just telling you what the value of the property is. I think many times we focus on the dollar amount of the assessment. I think if there's any takeaway from here, I will say that look at all the benefits that are available. Because like the assessment cap, even if your property goes up more than 10% of what it is, you're not going to be taxed, beyond that 10%. The senior citizen, the discount that is available. I think all those reliefs, is what people should focus on that. I'm not saying discountenance the assessment, but take advantage of all these benefits to lower what I call the tax burden or the real property tax. The assessment is a little bit different from the property tax because there are so many things that one can take advantage of that ultimately can reduce your property tax.
Thank you. I really appreciate that. And I think that's one reason why we're gathered together this evening to look at some of those benefits that residents may not know about. There is one question, though, also that if it states if you realize your household income is over the income level for the disabled credit and you submit a cancellation notice, will you have to pay back property taxes and penalties? So once you've submitted the notice, do you have to go back and pay something?
Yeah, I would encourage you to self-disclose. You always have the ability. The tax is the tax, and the DC statute doesn't allow us to forgive taxes. So if the taxes are owed, it's much better to be proactive about it, and then let's figure out how to pay back what you owe the district. As far as penalty and interest is concerned, you can always request the penalty and interest waiver for any assessment of those, any adverse findings based on that additional tax that is owed for back periods. So there is relief in that regard, but we always want to encourage taxpayers to self-disclose, and then we can work through the options you have to pay back versus us conducting an audit and us finding that out. It's a little bit different. It's a little different dynamic, and it's much better to be ahead of this than for you to think, well, hopefully I won't get caught. So, and then that changes the penalty and interest dynamic a little bit.
I want to take this last question because I think it's a question of the sign of the times. And this viewer said that COVID has caused a lot of hardship for the family. They've been looking for work, they're behind on bills, the taxes are owed. The bill is a total of about $5,000 for the year, and they simply can't afford to pay it. So how can, and you didn't get a chance to really talk about payments, whether you can have, whether there's a payment plan, or in this case, what would you tell this property owner about how, what they can do and release some of that stress I'm sure that they have right now because they don't want to lose their home?
Thank you. Yeah, it's a very pressing question that we get that quite often. So there is an option to enter into a payment plan. But if you have back taxes that are owed, you can enter in a payment plan for those back taxes for prior years, but then you have to be current in, first half TY 2022. Otherwise, if you if you're carrying a balance forward and a new tax half comes along, the system is going to cancel your payment plan. So what I would suggest doing is that you can visit our website, go to mytax.dc.gov, and it will show you the various options you have in payment plans. And then I'm happy to provide any additional information under the particular circumstances that you're facing, whether it's based on prior taxes that are owed, or if you're just experiencing this in this current tax half. But there is some relief.
Good. I want to thank you for that, because, and I appreciate the fact that you all are sharing, and we're going to share that again, your contact information. You know, sometimes when you're really in a bind or a pickle, or you're a senior, you know, you don't really want to communicate with the computer because, you know, you just don't know if the computer understands your real life situation. So I think it's great that Eva is there and the two of you all are there to answer questions in person, and we will post your contact information again. Actually, if we can do that now, that would be great. Okay, Chevy says it's there. Fantastic. So you know, we said an hour. We probably could have gone, we have gone an hour and a half. We could have gone longer. And we're thinking that we may want to revisit this at some time in the future. I really want to thank you and the Office of Tax and Revenue for allowing us to have this conversation. And I want to thank everybody that's joined us this evening. Austin, I'll turn it over to you so that, you know, we can make, and it is a pitch, you know, again, for our house newsletter, where we want to bring this kind of information to our readers. And lastly, I want to thank, you know, Natalie Wilson and Chevy Lassiter for bringing this program together this evening. Austin?
Yeah, and thank you again, everybody, for taking time out of your busy evenings to join us. Thank you in particular to everyone over the Office of Tax Revenue. I'm going to make a pitch again. The link is included in the chat. Please subscribe to the Our House DC newsletter so you can receive the newsletter every other Monday. And we will be including some answer to some of these questions in future editions of the newsletter. So thank you. Have a wonderful and safe evening.
Thank you and good night.